Imagine a life where money is no longer a constant source of stress. Picture yourself free from the weight of debt, able to pursue your passions. This is the promise of financial freedom, and it's a goal within everyone's reach. Building lasting wealth is about making smart choices consistently over time. It might mean early retirement, starting a business, or simply feeling secure. Achieving financial freedom starts with a plan. Financial freedom is about more than just accumulating wealth. It's about the freedom and opportunities that come with it. It's about reducing financial stress and anxiety, allowing you to focus on what truly matters in life. When you're not constantly worried about money, you can invest more time and energy in your relationships, passions, and personal growth. Imagine the possibilities when you're not bound by financial constraints. You could pursue a career change you're passionate about, even if it means taking a pay cut. Building lasting wealth is a marathon, not a sprint. There are no shortcuts or get-rich-quick schemes that will lead to sustainable financial freedom. It requires patience, discipline, and a willingness to make consistent efforts over time. It's about making smart choices today that will pay off in the years to come. Just like a marathon runner trains consistently and gradually increases their endurance, building wealth requires a similar approach. It's about developing healthy financial habits such as regular saving and investing, and sticking to them even when progress seems slow. Remember, even small steps taken consistently over time can lead to significant results. Don't get discouraged by setbacks or compare your progress to others. Everyone's financial journey is unique, and what matters most is that you're moving forward. Celebrate your successes along the way, no matter how small they may seem, as they are all stepping stones towards your ultimate goal. Throughout this essay, we'll explore proven strategies and practical tips to help you build lasting wealth. We'll cover key concepts such as budgeting, saving, investing, managing debt, and making informed financial decisions. Consider this essay your roadmap to financial success, providing you with the tools and knowledge to take control of your finances and create a brighter future. We'll delve into the importance of setting clear financial goals, understanding your risk tolerance, and diversifying your investments. We'll also discuss the dangers of lifestyle inflation, the power of compound interest, and the importance of seeking professional financial advice when needed. Building lasting wealth is an achievable goal for anyone willing to put in the effort. By adopting the strategies outlined in this essay and committing to a disciplined approach, you can pave the way for a more secure and fulfilling financial future. Remember, the journey starts with a single step, and the time to take that step is now. One of the most significant barriers to wealth building today is the widening income gap. In many parts of the world, the cost of living, particularly housing, healthcare, and education, has been rising faster than wages. This makes it increasingly challenging for individuals and families to make ends meet, let alone save and invest for the future. The struggle is even more pronounced for those living paycheck to paycheck, where even a small financial setback can have devastating consequences. When a significant portion of one's income is dedicated to basic necessities, saving for long-term goals like retirement or a down payment on a house can feel like an impossible dream. This income disparity often perpetuates a cycle of financial instability, making it harder for those with lower incomes to break free from the cycle and build wealth. It's like trying to climb a ladder where the rungs are getting further apart as you go up, making each step that much more difficult. Inflation, the steady increase in the general price level of goods and services over time, is another formidable barrier to wealth building. As prices rise, the purchasing power of your savings erodes, meaning the same amount of money buys less over time. This is particularly concerning for long-term savings like retirement funds, which can lose significant value due to inflation over decades. Imagine saving diligently for years, only to find that the nest egg you've built can no longer support the lifestyle you envisioned due to the rising cost of living. This is the harsh reality of inflation, and it's something that every aspiring wealth builder needs to be aware of. To combat inflation, it's essential to not just save money, but to make your money grow at a rate that outpaces inflation. This typically involves investing in assets like stocks, bonds, or real estate, which have historically provided returns higher than the rate of inflation over the long term. Our consumer-driven society often glorifies instant gratification and encourages us to live beyond our means, making it easy to fall into the trap of overspending. This is fueled by easy access to credit, targeted advertising, and the constant bombardment of social media, showcasing lifestyles many aspire to but can't necessarily afford. From impulse purchases to keeping up with the latest trends, unchecked spending habits can quickly derail even the most well-intentioned savings plan. This is especially true for discretionary spending on non-essential items, which can add up significantly over time. Breaking free from the spending trap requires a shift in mindset, focusing on needs versus wants and prioritizing long-term financial goals over short-term gratification. It's about making conscious spending choices, tracking your expenses, and developing a budget that aligns with your values and priorities. Section 4. The Debt Dilemma. High-interest debt, particularly credit card debt, can be a significant obstacle to building wealth. The high interest rates associated with such debt can quickly turn a small balance into an overwhelming burden, trapping individuals in a cycle of debt that seems impossible to escape. Every dollar that goes towards servicing debt is a dollar that can't be saved or invested for the future. This can significantly hinder your ability to build wealth as those funds are being diverted towards interest payments instead of growing your assets. Prioritizing debt repayment, especially high-interest debt, is crucial for achieving financial freedom. Developing a debt reduction strategy such as the debt snowball method, where you focus on paying off the smallest debts first to gain momentum, can be highly effective in breaking free from the debt cycle. Section 5. The Knowledge Deficit. A lack of financial literacy is a major barrier to wealth building. Many people are never taught the fundamentals of personal finance, such as budgeting, saving, investing, and managing debt, leaving them ill-equipped to make sound financial decisions. This knowledge gap can lead to costly mistakes, like falling prey to financial scams, making poor investment choices, or not taking advantage of available financial resources and opportunities. It's like trying to navigate a complex maze without a map or compass, increasing the likelihood of getting lost along the way. Overcoming the knowledge deficit requires a commitment to financial education, seeking out reliable resources, taking courses, reading books, or consulting with qualified financial advisors. The more you understand about personal finance, the better equipped you'll be to make informed decisions that support your long-term financial well-being. Section 6. Overcoming the barriers. While the barriers to wealth building may seem daunting, they are not insurmountable. By acknowledging these challenges and adopting a proactive approach, you can overcome these obstacles and pave the way for a more secure financial future. It requires a combination of knowledge, discipline, and a willingness to change ingrained habits and beliefs about money. Remember, building wealth is a journey, not a race. There will be setbacks and challenges along the way, but with perseverance and a commitment to making sound financial decisions, you can achieve your financial goals. Don't let these barriers define your financial future. Instead, use them as motivation to take control of your finances and create the life you envision. In the following sections, we'll delve deeper into practical strategies and actionable steps you can take to break down these barriers and build a solid foundation for lasting wealth. Building lasting wealth isn't about hitting the jackpot or discovering a foolproof get-rich-quick scheme. It's about cultivating a mindset of consistent saving and investing, making it an integral part of your financial routine. Just like brushing your teeth or exercising regularly, saving should become a non-negotiable habit ingrained in your everyday life. The beauty of habit formation is that it removes the emotional decision-making process. You no longer have to convince yourself to save each month. It becomes an automatic response, like clockwork. This eliminates the temptation to skip saving when money is tight or when other spending desires arise. By automating your savings, you can ensure that a portion of your income is consistently directed towards your financial goals, regardless of external factors. This disciplined approach forms the bedrock of long-term wealth creation, allowing you to steadily build a secure financial future. Many people fall into the trap of believing that building wealth requires a stroke of luck, a windfall inheritance, or a risky investment that pays off big time. While these scenarios can certainly accelerate wealth accumulation, they are not reliable or sustainable strategies for long-term financial success. Relying on such unpredictable events can lead to a cycle of financial instability, where you're constantly chasing the next big win instead of focusing on steady, consistent growth. It's like playing the lottery, hoping to get rich quick instead of investing in a solid financial plan. The problem with this approach is that it often leads to disappointment and can even result in significant financial losses. It's important to remember that true wealth is built gradually, through disciplined saving and investing, not through risky bets or hoping for a miracle. When it comes to building wealth, time is your greatest ally. The earlier you start saving and investing, the more time your money has to grow, thanks to the power of compound interest. This principle, often referred to as the eighth wonder of the world, allows your money to earn interest not only on your initial investment but also on the accumulated interest from previous periods. Imagine a snowball rolling down a hill, gradually gathering more snow and momentum as it goes. That's the power of compounding in action. The longer your money is invested, the faster it grows, creating a snowball effect that can significantly amplify your wealth over time. Even small amounts saved and invested consistently can grow into a substantial nest egg over time. By harnessing the power of compound interest, you're essentially putting your money to work for you, allowing it to generate more money without any additional effort on your part. Section 4. The Snowball Effect. Imagine two investors, Sarah and Mike, both starting with the same goal of building a $1 million retirement nest egg. Sarah begins saving at 25, while Mike starts at 35. Assuming a 7% return, Sarah will retire a millionaire while Mike will fall short. This illustrates the snowball effect of consistent investing. The earlier you start, the faster your wealth grows. Starting small, dreaming big. You don't need a large income to start building wealth. Start small and be consistent. Even $50 a month can make a difference. Establish the habit of saving and increase contributions as your income grows. Think of it like training for a marathon. Start with shorter distances and gradually increase. Building wealth is about starting where you are and increasing your savings rate over time. Section 6. Weathering the storms. Life is full of unexpected events, both good and bad. Just as you'll experience periods of financial abundance, you'll also face times of financial hardship. The key is to be prepared for these fluctuations and to maintain your savings habit even when times are tough. This is where an emergency fund comes in handy. Having 3 to 6 months' worth of living expenses saved in a readily accessible account can provide a financial cushion to absorb unexpected expenses without derailing your long-term savings goals. During periods of financial strain, it's understandable to feel tempted to dip into your savings or investments. However, it's crucial to resist this urge whenever possible. Remember, every dollar withdrawn from your long-term savings is a dollar that's no longer working for you and benefiting from the magic of compound interest. Section 7. Consistency, your key to success. Building lasting wealth is not a sprint, it's a marathon. There will be ups and downs, market fluctuations, and unexpected life events that may challenge your financial resolve. However, the one constant that will ultimately determine your success is consistency. By making saving and investing a non-negotiable part of your financial routine, automating your contributions, and staying committed to your long-term goals even during challenging times, you can harness the power of compound interest and watch your wealth steadily grow over time. Remember, building wealth is not about perfection, it's about progress. There will be times when you stumble or deviate from your plan, The key is to learn from these experiences, adjust your approach as needed, and most importantly, never give up on your financial aspirations. Section 1. Beyond the piggy bank. While saving diligently is crucial, it's only the first step towards building lasting wealth. Think of saving as building a strong foundation for your financial house. It's essential, but it won't create the kind of growth needed for long-term financial freedom. That's where investing wisely comes into play. Simply put, investing is about putting your money to work for you. Instead of letting your savings sit idle in a low-yield savings account, investing allows your money to potentially grow at a faster rate, outpacing inflation and building wealth over time. It's like planting a seed and nurturing it. With time, care, and the right conditions, it can grow into a flourishing tree. This doesn't mean throwing your hard-earned money into risky ventures or chasing the latest investment fads. Investing wisely requires a strategic approach, understanding your risk tolerance, and selecting investments that align with your financial goals and time horizon. Section 2. Risk versus reward, finding your balance. One of the fundamental principles of investing is the relationship between risk and reward. Generally, the higher the potential return on an investment, the higher the risk involved. Conversely, investments considered lower risk tend to offer lower potential returns. Imagine a spectrum with low-risk, low-return investments like government bonds on one end and high-risk, high-return investments like individual stocks on the other. Finding the right balance on this spectrum based on your financial situation, goals, and risk tolerance is key to creating an investment strategy that works for you. For instance, someone nearing retirement might prefer lower-risk investments to protect their nest egg, while a younger investor with a longer time horizon might be more comfortable taking on higher risks for potentially higher returns. Understanding your risk appetite and aligning it with your investment choices is crucial for long-term success. Section 3. The long game patience in investing. Building lasting wealth through investing is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. Don't fall into the trap of chasing quick profits or making impulsive investment decisions based on market fluctuations or short-term trends. Remember, the stock market will always have its ups and downs, and trying to time the market perfectly is nearly impossible, even for seasoned investors. Instead, focus on building a diversified portfolio of quality investments and staying committed to your strategy, even when the market gets bumpy. Just as a farmer patiently tends to their crops, nurturing their growth over time, successful investors understand that building wealth takes time, and that consistency, not timing the market, is key to achieving their financial goals. Section 4. Diversification. Don't put all your eggs in one basket. You've likely heard the adage, don't put all your eggs in one basket. This age-old wisdom holds particularly true in the world of investing. Diversification is a risk management strategy that involves spreading your investments across various asset classes, industries, and geographical regions. Think of it like building a strong and stable wall. Instead of using just one type of brick, you use a variety of bricks, each with its own strengths and weaknesses, to create a more resilient structure. Similarly, diversification helps mitigate losses by ensuring that if one investment performs poorly, others can potentially offset those losses. By diversifying your portfolio, you're essentially hedging your bets, reducing the impact of any single investment on your overall returns. This strategy helps smooth out the volatility of the market and provides a more stable path towards your long-term financial goals. Section 5. Riding the market waves. The financial markets, much like the ocean, are in constant flux. There will be periods of calm and prosperity followed by storms and uncertainty. It's important to remember that market fluctuations are a natural part of investing and not something to be feared. Instead of panicking when the market dips, view these downturns as potential buying opportunities. Just as a surfer waits for the perfect wave, savvy investors understand that market corrections can present opportunities to acquire quality assets at discounted prices, potentially enhancing their long-term returns. The key is to avoid making emotional decisions based on short-term market movements. Stick to your investment strategy, maintain a long-term perspective, and remember that time in the market is often more important than timing the market. Navigating the complexities of the financial world can be challenging, even for experienced investors. If you're feeling overwhelmed or unsure about how to create a sound investment strategy, don't hesitate to seek guidance from a qualified financial advisor. Think of a financial advisor as a trusted guide, helping you navigate the often complex world of investing. They can help you define your financial goals, assess your risk tolerance, create a personalized investment plan, and provide ongoing support and adjustments as your needs and circumstances change. Just as you wouldn't hesitate to consult a doctor for health concerns, seeking professional financial advice can provide valuable insights, peace of mind, and potentially save you time, money, and costly mistakes in the long run.
Imagine this. You receive a well-deserved promotion or a significant raise. It's exhilarating. You feel financially secure, even a little bit flush. Naturally, you want to celebrate your success and reward yourself. Suddenly, that bigger apartment, the new car, or the designer handbag doesn't seem so out of reach. This is the siren song of lifestyle inflation. Falling prey to lifestyle inflation can sabotage your long-term financial goals. Lifestyle inflation often operates on a subconscious level. We get used to a certain standard of living and start considering what were once luxuries as necessities. That daily latte, the frequent restaurant meals, or the subscription boxes we barely use become ingrained in our routines. As we acclimate to this elevated spending pattern, our savings rate stagnates, or worse, decreases. We might even find ourselves taking on more debt to maintain this lifestyle, justifying it by telling ourselves we'll earn more in the future. This creates a dangerous cycle where income increases are negated by increased spending, leaving little room for savings or investments. Breaking free from this cycle requires awareness and a conscious effort to prioritize saving and investing over constantly upgrading our lifestyle. It's not about depriving yourself, it's about making mindful choices that align with your long-term financial goals. The good news is that combating lifestyle inflation doesn't require drastic measures or sacrificing all the joys in life. It's often the small incremental changes that, when implemented consistently, have the most significant impact on our finances over time. Instead of upgrading your car every few years, consider driving it for a few more years and investing the money you would have spent on a new car. Instead of eating out multiple times a week, try cooking at home more often and treat yourself to a special meal out once in a while. Remember, it's not about deprivation, it's about making conscious choices that align with your values and priorities. By finding joy in simpler pleasures and experiences, you can curb unnecessary spending and free up more resources to invest in your future. One effective strategy to combat lifestyle inflation and boost your savings rate is the 1% challenge. This simple yet powerful approach involves increasing your savings rate by just 1% every few months or whenever you receive a raise or bonus. For example, if you're currently saving 5% of your income, aim to increase it to 6%. Then after a few months, bump it up to 7% and so on. The beauty of this approach is that it's gradual and almost painless. You're unlikely to even notice a 1% difference in your take-home pay, yet over time, these small increments can add up to significant savings. This approach allows you to gradually adjust to a higher savings rate without feeling deprived or overwhelmed. It's a sustainable way to build wealth over time, ensuring that your savings keep pace with or even outpace your lifestyle inflation. Breaking free from the clutches of lifestyle inflation is not about living a life of austerity or denying yourself the joys of success. It's about making conscious choices that align with your long-term financial aspirations. It's about understanding that true wealth is not measured by the size of our homes or the brand names we wear, but by the financial security and freedom we create for ourselves and our families. By adopting a mindset of mindful spending, embracing the power of incremental savings, and resisting the urge to constantly upgrade our lifestyle, we can break the cycle of inflation and create a brighter financial future. Remember, building lasting wealth is a marathon, not a sprint, and every step we take towards financial freedom is a step worth celebrating. As we continue our journey towards building lasting wealth, we'll explore other practical tips and strategies to help you optimize your finances, make informed investment decisions, and achieve your financial goals.
We've all heard the saying, it's the little things that count. Small daily expenses, often dubbed the latte factor, can impact our long-term savings. Spending $5 on coffee every weekday equates to $25 a week, $100 a month, and $1,200 a year. Redirecting that could grow into a substantial nest egg. Let's put the latte factor into perspective with a real-life example. Imagine two individuals, both earning the same salary, both committed to saving for retirement. Individual A indulges in a $5 latte every weekday, while individual B opts for a more budget-friendly homemade coffee. Assuming an average annual return of 7% on their investments, over 30 years, individual B, the one who skipped the lattes, would have accumulated an additional $100,000 in their retirement account. This eye-opening figure highlights the profound impact of small, consistent savings over time. This example isn't just about coffee, it applies to any recurring expense that we often overlook. That daily takeout lunch, the magazine subscriptions we barely read, or the impulse online purchases we make out of boredom, these small expenses, when accumulated, can significantly impact our ability to save and build wealth. Reclaiming control over your finances doesn't require drastic lifestyle changes or sacrificing all the things you enjoy. Make conscious choices, cut back without feeling deprived, and redirect funds towards your financial goals. See the latte factor as an opportunity to be mindful about spending and make your money work harder. Brew coffee at home a few times a week and treat yourself on weekends. It's about empowerment, not deprivation. Invest in a brighter financial future. In today's hyper-connected world, social media's influence is impossible to ignore. While great for staying connected, it can fuel unhealthy financial habits. Social media often presents a curated, unrealistic portrayal of lives. We're bombarded with images of luxury, creating envy and inadequacy. This exposure distorts reality, pressuring us to keep up with influencers. We measure success against unrealistic standards, harming our financial well-being. Remember, social media is a highlight reel, not a documentary. Social media has amplified the age-old phenomenon of keeping up with the Joneses, taking it to a whole new level. It's no longer just about comparing ourselves to our neighbors or colleagues. It's about measuring our lives against a constant stream of perfectly curated images. This can lead to a dangerous cycle of FOMO and impulsive spending. We see someone jetting off to Bali or sporting the latest designer handbag, and suddenly we feel an urge to book a similar trip or purchase that same handbag, even if it means stretching our budget. Section 3. Defining your own success. Breaking free from the social media comparison trap requires a conscious shift in mindset. It's about recognizing that true wealth and happiness are not defined by the number of likes we receive or the material possessions we accumulate. It's about defining success on our own terms, based on our values, priorities, and aspirations. One effective way to combat social media envy is to be more intentional about the accounts we follow. Unfollow or mute accounts that trigger feelings of inadequacy or fuel unhealthy spending habits. Instead, seek out accounts that inspire you, provide valuable information, or align with your values. Remember, you are not your possessions, and your worth is not tied to your online persona. Focus on cultivating a sense of gratitude for what you have and celebrating your own unique journey, both online and offline.
Imagine this. You're strolling through the mall, browsing for a new outfit, when you spot the perfect pair of shoes. You tell yourself, I deserve a treat, or I'll just put it on my credit card. This is the slippery slope of high-interest debt. It starts small and spirals into a mountain of debt. Breaking free is crucial for long-term financial security. Credit cards and other forms of high-interest debt are often marketed as convenient tools for managing your finances. While they can be helpful for emergencies or building credit responsibly, it's easy to fall into the trap of using them for everyday purchases, racking up balances we can't afford to pay off in full. This is where the real cost of convenience rears its ugly head. The high interest rates associated with credit cards, often ranging from 18% to 30% or more, mean that every dollar you borrow ends up costing you significantly more in the long run. It's like paying a hefty premium for the convenience of delaying payment, a premium that eats away at your hard-earned money and hinders your ability to save, invest, and build wealth. The longer you carry a balance, the more you pay in interest, creating a vicious cycle that can be challenging to break free from.
Building lasting wealth and achieving financial freedom is a journey, not a destination. Make conscious choices today for a secure financial future. Consistent saving and compound interest can amplify your wealth. Remember, it's about progress, not perfection. Stay committed, adjust as needed, and emerge stronger. The most significant step you can take towards achieving financial freedom is to start today. Don't wait for the perfect time or until you have a surplus of income. Even small changes implemented consistently can have a profound impact on your financial well-being over time. Start by setting clear financial goals, whether it's saving for retirement, buying a home, or achieving financial independence. Break down these goals into smaller, more manageable steps, and create a realistic budget that aligns with your income and expenses. Remember, building lasting wealth is a marathon, not a sprint. It requires patience, discipline, and a willingness to make consistent efforts over time. But the rewards are well worth the effort. Imagine the peace of mind, the freedom, and the opportunities that come with knowing you're financially secure.